Hey guys, welcome back to the channel Dennis on a Dime. If you're relatively new to the channel, go ahead and click on the subscription button. Give it a thumbs up on this video. Today we are going to be talking about credit cards. Are they evil? Are they good? What is my thought on credit cards? So ultimately, credit cards are a tool to help build credit. And that is my honest opinion. They are, for most young adults, it is the very first exposure they're going to have to credit, to managing debt, to managing credit cards. They are a product that allows you to make purchases without having cash on hand. Now, with that being said, guys, according to NerdWallet, they said 10% of Americans think that credit cards are evil and the reason why we are seeing all the problems in the world that we are today. Now, in my opinion, again, not using credit cards properly can inherently be very bad and can also be very detrimental to your credit score. So some of the benefits we're going to go over, some of the pros and cons. Number one, of course, the benefit is they are easy. They are very convenient to use. When you go to make a purchase, you can just use your card. You don't have to have an ATM to have cash. You can use it for major expenses. And a credit card essentially fronts the cost for a couple weeks. Now, with the majority of cards, if the balance is paid in full, and we're going to get into this in a little bit, if the balance is paid in full every single month, you don't pay interest. Let me say that one more time, guys. For a majority of credit cards, if you are paying them off in the month that the purchase is made, you do not pay interest. That is right, guys. It doesn't matter if your credit card percentage is 12%, 20%, 28%, whatever it is, guys. You do not pay interest, again, on a majority of credit cards if the balance is paid off within the month. Another pro of this, guys, is the ability to build credit. Like I was saying earlier, one of the biggest things is credit cards are going to be the starting point of good credit for younger adults or for people that are rebuilding their credit card or their credit. If they're looking at, a $300 card or a $500 limit card, this can really establish a good payment history. And for our younger generation, it can really go in and start fundamentally building the processes of building good and excellent credit. What I mean by that is they can learn to make purchases on it. They can also learn to manage the payments on there and not spending more than they can essentially go ahead and use that they're going to put on the card. So if you have a young adult that only has a $300 limit, the card is low risk because there is not a high limit. It's not like we're giving them a $5,000 limit off the bat that they can go buy whatever they want, but this is going to build the credit history. Further down the road, even years down the road, this is going to be very important when they go to get their first home, when they go to get their first car. The credit score is going to determine your rate. Now, good credit, bad credit, again, your score is going to determine your rate. So if you have a score, let's say, of 20 or 720 or better, you're going to have A+ credit. They're going to give you a good rate for everything, or a higher, a lower interest rate, but you will have a good score. Adversely, let's say you have a 500 score because you've missed a lot of payments. You're going to have a much higher rate on credit cards, and the willingness for a lot of financial institutions to borrow to you are going to go away and going to go away very quickly. Now, again, using your card to build credit or using your credit card to build your credit, really two things I focus on. One, making sure that you do make a purchase throughout the month. And the second one is making a payment in full, meaning the card is going back down to a balance or back down to a zero balance. That can really do two things. It's going to increase your credit history. It's also going to keep the capacity of that card to 100%. Now, in addition to helping build your credit, guys, is a lot of credit card companies, if you've noticed, they give cash back, they give travel rewards, they give this, they give that. There is an incredible amount of things that they do. You get benefits at hotels, you get benefits at airports, you get hotel room upgrades, lounge discounts, discounts at merchants. Again, everybody is looking to really capitalize on the income that comes from credit cards. And honestly, if it really wasn't there, and if the credit card income wasn't so strong, there would be less cards. Less companies would offer less cards if there wasn't a benefit in there to make a lot of money. Now, a lot of cards also do protect you from purchases. If there is ever a fraudulent purchase, you're protected by Visa, you're protected by MasterCard. A lot of them also do offer additional benefits like trip cancellation, reimbursement for baggage, rental car insurance, roadside assistance, there are an incredible amount of perks on certain cards that a lot of people do really enjoy. Also with the reimbursement for charges. So if you do have fraudulent charges on there, reimbursement does come relatively quick. And also with that, one of the big factors that I think of when I think of credit cards is it is not actually your money that you're utilizing. Now, a lot of people don't really see or differentiate the difference between this. But if you are utilizing a debit card versus using a credit card, the debit card is linked to funds in a checking account. The credit card is not linked to your funds whatsoever. Now, it might be linked to the credit line that you have at the institution where the card is drawn, but it is not linked directly to your checking account and linked directly to your funds. So those are just some of the pros that we've seen with cards. Now, some of the drawbacks. Now, the drawbacks on these guys can be detrimental if the debt is not managed. So according to the Federal Reserve, average rate is 18.43%. That is right, guys. We're at 18.5% for credit cards, which is absolutely insanity. And in the US, per capita, so per person within the United States, credit card debt is around $7,000. Now, if you think of that, guys, almost 18.5% rate, $7,000 is the average. Incredible. You are paying, I would say roughly at that, you're probably paying around $130 per month in straight nothing but interest. That is right, guys. Let me say that one more time. You're making a payment. Let's say your payment's $200. $50 is going on the $7,000 that is owed. $150 of that, or roughly 150 is going towards interest, which again is absolutely incredible. That is the reason why I say, guys, with the higher rate of credit cards, do not pay interest. Make sure that you're paying those off. There are other methods or other avenues to get the money you need versus using credit cards, because the way that the credit bureau actually sees it is you are overspending, or you're essentially supplementing your income with credit card debt. So if I make $2,000 a month and I'm spending $2,500 a month, that $500 is going on my credit card every single month. Well, you get to a point where that is no longer viable, because now the debt that you've exceeded on the card and your monthly liabilities are much higher than your $2,500. So you're running in the red every single month, because again, essentially you're supplementing income with credit card debt. With that being said, guys, credit cards have revolving line, meaning that if you do need money, there is an opportunity to utilize that, which means that even during the pandemic, where unfortunately we've seen a lot of people with job loss, seen a lot of unexpected medical bills, things of that nature, it may, in my opinion, the credit cards are not the best avenue to use during that time. There's unsecured loans, there's things of that nature. Problem is, in that scenario, you cannot get approved because you do not have income, but you have a credit card that can actually support you for a very small term once that emergency fund is gone. Now, with that being said, guys, focusing on paying this down is a big priority, using either the snowball method or the avalanche method, which we both talked about in previous videos. Now, also, guys, you have to be careful, because some of the terms, some of the conditions, you really have to read the fine print. I know a majority of people do not, but there are a lot of things in there where they say, okay, well, your interest rate is 18.5%. If you miss a payment, your credit card rate is going up to 29% for the remainder of having the credit card. Again, you have to know the ins and outs. Even if it comes to rewards programs, even if it comes to benefits, guys, you have to know the ins and outs of the card. Now, big thing about this, guys, that I really want to sum it up with is use your cards responsibly. Credit card debt is an absolute pandemic of its own. The amount of debt, essentially, like I said, $7,000 per person is the rough estimate of what they have for credit card debt. But the first credit card, if utilized responsibly, if paid off in full every single month, you want to make sure that you do make the bills on time, that you are paying the minimum payment if that's all you can on time, ideally paying it off in full, because that is going to benefit you with not having to pay interest, and never use too much of your credit line. So 30% or less is the general rule of thumb. I like to say 20% or less, because again, with the utilization, it can have a big impact on your credit score. And in the next couple of videos, we're going to be breaking down the credit score, things that can really adversely affect it, how you can improve your score, and things of that nature. Also with credit cards, they are a line that you can have for a considerable amount of time. Now with most loans, if you do a loan for 36 months, 60 months, after the 3 years, after the 5 years, the loan is gone. It is completely repaid and forgotten. Credit cards do have a perpetual life, meaning that you could have the same credit card essentially for your entire life. If you have a cosigner on there, if you have a joint owner on there, even after someone has passed, that card can continue on with somebody else, which is very interesting to see. But also with the cards is you can establish a very long credit history. Me personally, I've had the same credit card for probably about 7 years now, which is quite a long time to have a credit card. I actually have it through M1 Finance. They have an owner's reward card, which is absolutely phenomenal. That is what I use, guys. I pay it off every single month in full, so I never pay interest on it, but it does give me access to cash back in the form of stocks within companies that I hold. So again, a very, very cool card. I do have an affiliate link right down below if you want to check it out, but it is what I use. As we get more into detail and more of the breakdown of the credit card, the usage, the utilization, things of that nature, and that affects your credit score as well. So guys, that'll do it for today's video. Let me know in the comments what you guys think, and as always, thank you guys for watching.